As difficult as historically high inflation can be on your bottom line, are there ways to make it work for you? Steve Wyett is the Chief Investment Strategist for BOK Financial. Joins us again this morning to talk about taking advantage of interest rates. Good morning, Steve.
Hi, Dave. Good morning. Good to see you again.
It's great to see you again. We want to talk about the relation of inflation and interest rates right now. Kind of tell us how these are intertwined.
So, here's the good part about the inflationary cycle. It caused the Federal Reserve, as a response to that, to have to start raising short-term interest rates. And if you're a saver, that's been a very good thing. We've had interest rates at basically zero for the last 15 years. That's pretty good from a borrower standpoint, but if you were a saver, if you had liquidity, you're earning nothing on your cash over that period of time. So as the Fed has raised interest rates, that's brought short-term interest rates higher, and that's produced an opportunity for savers with short-term money not having to take a whole lot of risk to actually earn some interest on their money, and that's been a good thing.
So with inflation, is it seeming to cool off? Let's start with there. I mean, kind of where is the arrow pointing with the inflation, and where's the arrow pointing with the interest rates in your view here?
You know, we had our first conversation around inflation about 8 months ago, as I recall,
Yes.
from a memory standpoint, and our statement at that time was that inflation was going to come down over time. That is occurring. We're seeing headline inflation in the most recent CPI reading was down to 5.1. Now, 5.1 is still high, but it's not 9% where it was. So we're going the right direction.
That's something, yeah.
That will mean that at some point, and we're getting close to this, the Federal Reserve's going to be able to quit raising interest rates. They have another meeting in May. As they meet then, we think we're really close to being able to see the Fed stop raising interest rates. We think they're going to be slow to lower interest rates. So these short-term interest rates could stay high for some period of time. But at some point, yes, as inflation goes back towards 2%, the Fed's target, they'll begin to lower interest rates in the next 12 to 18 months.
I wanted to talk about some options for folks out there, maybe things that we should be doing to put money into a savings in the sense of where we can earn interest on our money. Because obviously if we keep that money in our pocket, if we put it in our basic checking account, it's just going to stay where it is. How do we take advantage of the interest rates?
So this is where you need to visit with your financial advisor, visit with your banker. There are money market mutual funds. That would be if liquidity is still an issue, you want to have access to your money on a daily basis. Money market mutual funds are stable NAV, dollar in, dollar out. You can access the money on a daily basis. And those are paying today around 4.5 to 4.7%. If you're willing to go a little bit longer, you can actually get some Treasury bills. These are direct purchases from the Treasury, guaranteed at an unlimited amount. You're not limited to any FDIC insurance limit or something of that nature.
Right.
And we're getting close to 5% on those. So there are things that we can do. These are not difficult options to pursue. Just visit with your financial advisor, your banker, and study those options and figure out which one's best for you.
I know it's different for every person, but I wanted to ask about certificates of deposit, CDs, because years ago, 15, 20 years ago, this was a really hot product in financial advice circles. Hey, you get CDs, you lock in this high interest rate, and 12 months later, voila, your money has grown. What is kind of your pros and cons of a CD, for example, since you can't touch it for part of it?
Well, they became not a hot product when interest rates fell.
Exactly,
so,
fell off a cliff.
As interest rates have come back up, CDs are coming back into vogue, and you are seeing banks, which were slow to raise interest rates for deposits as the Federal Reserve was raising interest rates very quickly. Banks weren't raising interest rates that quickly, but they've begun to do that. So now, this is another way that you can take advantage of investing your money in a way that remains FDIC insured, even if you have more than $250,000, because every bank you buy a CD in, you get $250,000 of protection at each of those institutions. So there are a number of programs out there where you can see the interest rates from different banks, and different banks will pay different rates. They have different needs for the money, and so those banks that their business is good, they've got a lot of loan demand, they'll pay a little bit higher interest rate, and as long as you stay below that $250,000 limit, it's all FDIC insured, and so you just get the highest rate possible.
Well, Steve Wyett with BOK Financial, we always appreciate your time. Thank you so much for being on with us today and talking about this important topic.
Yeah, and good luck.